Welcome to your Hamby webinar today. I am today here with Dunbar.
Uh-oh, is it just me or is Judy freezing?
Judy's freezing.
And Sonia.
Judy, we think you might be frozen. Tom and Sonia, is Judy frozen on your feed?
She's frozen.
Yeah, she's frozen on my end.
And we are looking forward to updating you on Deephaven's. Tom, where are you visiting us from today?
I'm visiting you from the other side of the United States, all the way in sunny South Florida in the subtropics, about 50 miles from the Bahamas, in Fort Lauderdale, Florida. So I live about a mile from the beach. So yeah, plenty of sun, plenty of coconut and palm trees down here, just like Hawaii.
Now I'm gonna send Judy a text.
Oh, perfect.
Yeah, she's.
How about you, Sonia? Where are you joining us from?
Hi, Kelly. I'm in Orange County, California. So also close-ish to the beach. So I think all of us here are used to cool, controlled, warm temperatures. So can't be far from the water, but nothing beats a Hawaii sunset. So, but this is the next best thing. So
that's the truth, isn't it? Yeah, we're all a little spoiled weather-wise, I think, aren't we?
Yeah, definitely.
All right. Judy, are you back? It looks like you might have cleared your screen. Are you with us or not quite live? Not quite live.
Yeah.
All right. Well, why don't you guys tell us a little bit more about what you do at Deephaven, and we'll spend a little time chatting before we get started to make sure we have time for everyone to join us.
Sure. So Tom Davis here, Chief Sales Officer at Deephaven. I've been at Deephaven for going on 5 years now. We were a pioneer in the non-QM space. Deephaven was founded in 2013, right out of Dodd-Frank. And so we specialize in non-agency. What makes us unique is we have a full suite or an arsenal of non-agency product. And what does that include? That includes non-QM. It includes equity, which we have a closed-end second, as well as a digital HELOC, as well as we offer RTL loans, which is residential transition loans, so fix and flip, ground-up construction of 15 million. So have a full suite of non-agency. You'd have to, and it's a sizable part of the market. In 2026, it's going to be close to 400 billion in originations in a $2 trillion market. So 1 out of every 4 deals. Sizable part of the market. If you're not paying attention to these products and not embracing them, then you're potentially allowing your customers to go to your competitors down the street. So outside of that, I run sales at Deephaven, run wholesale, non-delegated and delegated channels, and very active with NAMBI, all the multiple states, on multiple boards, and I actually am the chairperson of the board Mortgage Bankers Association's non-agency committee in DC.
Awesome. Thank you, Tom. And my apologies, everyone. I got lost for a second, but I'm back now. Sonia, were you able to introduce yourself as well?
Just where I'm living. So if you want to find me, come over to Southern California.
Tell us a little bit about your role with Deephaven.
Yeah, absolutely. Thank you, Judy. I'm an account executive here. Started here about a year ago, and I'm just having too much fun. I've been in this business for, as we all have, since agency was manual, so this feels very natural. I love non-QM because it feels like that. It's a solution-based product. I feel like we've now gone away from agency, non-agency, and it's really just solutions at this point. So I just am having too much fun because there's so many solutions out there, and the best part is being able to show those options to broker partners. And yeah, and I get to do it all day long.
That's so awesome. And I love Deephaven. Actually, Deephaven is one of our correspondent lenders, and we are just thrilled with your products. And there's such a vast array of offerings. Awesome. Okay, well, everyone, it is 10:06, so let's go ahead and jump right in. Welcome again, everyone, to everyone that has joined. Welcome to your Hamby webinar for this month. We are with Deephaven. We're with Tom Davis, as well as Sonia Eckbart, and of course, Kelly Dunbar, your education co-director, and myself, Judy Meredith. Welcome, everyone. We are really looking forward to Deephaven's presentation today. But Kelly, do you want to go ahead and start with some Hamby announcements?
Absolutely. Take a moment just to tell you about some upcoming events that we've got going on. August 5th, we have the New Res webinars. It'll be similar to our Deephaven webinar, but that one will be hosted by our own Charmaine Brooks. On August 25th, we have our annual Hamby conference. It's the biggest event of the year, you guys. We get our continuing education completed. We get to spend some time seeing each other and having a great day, followed by the very next day, the Appraisal Institute's and Hamby sponsored golf tournament. It's a great fundraiser. We're still looking for foursomes to join. So if you need information, please reach out to any of us, myself, Judy, Wade Nakasone, our president, or just the Hamby website. We'll be happy to get you some more information on that. And then leading into September, we have another webinar, Word to Kind Lending. And while I just keep rolling, I'll mention our Hamby sponsors. For our platinum sponsors, we have PennyMac TPO, we have the Loan Store, Lensure, New Res, our very own Deephaven today, The Kind, Remen, and yours truly at Freedom Mortgage. For our gold sponsors, we want to thank Finance Factors, Angel Oak, Title Guarantee, Accra, Advantage Credit, Foundation Mortgage, and Home Express. And last but certainly not least, our silver sponsors. We have Union Home Wholesale, Logan Finance, Cardinal, and Arc Home. And without further ado, why don't we let Tom and Sonia tell us all about the great things that they're doing at Deephaven.
Sure. So I'll kick us off. I think we're going to get into some slides, but once again, Deephaven's a non-QM or non-agency provider. What makes us unique is you would have to work with probably 3 or 4 different investors to get a full suite of products that we have at Deephaven. So we have obviously non-QM, traditional bank statement, DSCR. We have equity products, closed end, as well as HELOCs. And then we also have access to RTL. And by the way, our equity products, we can go to $1 million. So basically a jumbo equity product. And then we have also access to residential transition loans for business purpose, which is your fix and flip, ground up construction, and your bridge loans. So today I think we're gonna get into a little bit cover equity, right? Here's the backdrop. You have let's call it 35 trillion in equity in the United States. It's at an all-time record. We have 75% of Americans have rates under 5%, right? So there's this locked in rate effect where borrowers are not touching their first rate mortgage, right? And so they still need access to the cash, right? And in the United States, there's 24 million millionaires. Of those 24 million millionaires, 75% are millionaires due to their equity in their home. When you strip out the equity, there's only really 6 to 7 millionaires in the United States that are millionaires due to their liquid assets. So we're very, very, very equity rich country. And so as everyone knows, rates are elevated. Don't think rates are going to come down here in the near future. We had some issues in the Iran conflict overnight that elevated the 5-year and 10-year note rate to a level you haven't seen in the last 6 months, so almost a year. So rates are elevated. We have inflation, right? I don't see things rates coming down. If you look at Fannie or Freddie's or MBA's, and other forecasts out there, rates are expected to stay elevated for the next 2 to 3 years. And so, the refinance cash out game has been sidelined. The cash out game is equity products. And another couple of data points around the backdrop. You have in the United States, the average home in the United States is 40 to 50 years old. So you have an age housing stock, which is, close to 50 years old in the United States. And homes need to be renovated. People are going to be staying in their homes and they need to renovate their homes. So you're more than 50% of equity extraction, right, is coming from is being used for home renovations. In fact, in 2026, there's going to be over $600 billion in renovation projects. So that's the number one use case today on equity. The second use case is people are using their equity to consolidate debt. Consumer debt is at an all-time high at $5 trillion. And those credit card rates, auto loan rates are much higher than a equity rate or a closed end or a HELOC. So people are using their equity to consolidate debt. Self-employed people are tapping into their equity to fund their businesses. There's over 19 million investors in the United States that need to tap into their equity to renovate their portfolios, taking cash out to buy other investment properties. And then there's other life events, right? Kids going through school need a reserve fund. Maybe parents, have parents that need some long-term care. Maybe putting up an ADU for the grandparents or the kids, right? So make no mistake, equity extraction in 2026 in the first quarter of 2026 was the highest level in the last 20 years. And it's not coming from refi cash outs. It's actually coming from equity second lien transactions. So if you're not serving your borrowers and don't have these products, they have a financial need. They're not going to give up their first rate. What they're doing is they're going to go somewhere else that has these products, right? And where they're going a lot of these times, if you don't offer these products and you don't stay engaged in front of your clients, they're going to go to the servicer, and the servicer is going to offer them these products. In fact, the largest originators in the country in equity products are actually servicers, right? They buy the loan and then they immediately start targeting them for a refinance transaction. But since rates are high, they're actually targeting them for second lien transactions, whether they're closed end seconds or they're HELOCs. And so and loan officers across the country that don't really embrace and adopt these products, what's happening is you're seeing their retention rates really suffer. If you look at mortgage bankers and just mortgage brokers in general, their average retention rate on our past client, if you look at Redder data, that's a service out there, on average, only 35% of the clients are coming back to them for a second loan. They're going somewhere else for the second loan. So think about, you own a store, they come into your store the first time, the second time they're not coming back more than 2/3 of the time, they're going somewhere else. So the best originators, the top originators, stay engaged with their clients. They provide value. They're more of a financial advisor. So we're seeing originators, brokers, bankers across the country embrace these products so they could stay in front of them because all their past clients have equity, right? If you look at all your clients over the last 10 to 15 years, the majority of them have equity, right? Vast majority. Once again, 75% of Americans millionaires are millionaires because of their equity. So what a great conversation a loan originator or a mortgage broker could have by picking up the phone, congratulating their past clients and saying, congratulations on the equity that you have. Congratulations on that low note rate that I helped you get 2 or 3 years ago. You'll never see that in your lifetime again Rates are expected to stay elevated. How are things in life? Are you looking to renovate your homes? It was built in the 1970s. Are you looking to put on a new roof? Are you looking to renovate the kitchen? Are you looking to, let's call it, are you looking to consolidate debt? Are you looking to put the kids through school? How's business? Are you looking to fund your business or any ventures, right? I have tools that I can help you access that equity. So we're seeing a mass adoption on these products across the United States. In fact, close to 30% of my production is actually equity production. We've been actually growing in a tough market, challenging market. We've actually continued to grow and achieve record levels of production because we're bringing value to our customers and our brokers and bankers and offering them products so they could stay front and center of their clients, so they could add value, so they could stay engaged, right? And so equity where it's at, right? And if you don't have access to these tools and you don't stay engaged with your clients, they're going to go somewhere else, right? So that's kind of the equity backdrop. We can move to the next slide. If they could hear me. Okay. All right. So database, right? So you got to look at your database, right? Once again, all your clients you've ever done business with, they have equity, right? And when you look at these products, what's interesting is since we're in the non-QM or non-agency world, we've created products that actually have a non-QM income qualification flavor to them. And what I mean by that, self-employed, right? We have the ability to offer products for your self-employed borrowers through bank statements, right? So they could qualify for an equity, product. One way to do that is, filter through your database of self-employed borrowers or 1099 borrowers that you've done in the past. Another way is work with CPAs, accountants, business clubs in your local community, right? Those are all folks that work with self-employed people that are looking to tap into their equity. I would start with once again, with that past database. Talked about CPAs, accounting or tax season just wrapped up 2-3 months ago. The CPA and accountant are phenomenal referral sources for self-employed borrowers, whether it's for standard non-QM bank statement deals or equity deals, right? The CPA, the accountant, their number one job as a profession is to optimize their client's tax strategy, to write off, be within the code and maximize those tax write-offs, right? Well, we could qualify them for a second or first lien mortgage with just looking at their bank statements or qualifying them off their cash flow. So that's another way. And then last but not least, we also have a P&L only for closed-end second. And I would say on our closed end, what makes us unique, we have a jumbo product. I think Sonia will talk about that later. There's no other investor in the nation that allows to the loan amounts that we offer in today's market, both on our closed end seconds and our HELOC products. Moving on. All right, investors. All right, so here's a place or a takeaway I'd tell all LOs on this call. You want to look at your book of business and your production over the last year. That's the first thing I would tell everyone to do. And look at all your transactions. And if 30% of your transactions, once again, 30% of your transactions are not investor transactions, then you're under indexing the market, right? You could probably find data, around Hawaii. There might be some other folks from Hawaii on this call, but maybe from other states. But you could actually pull data to see what percentage of transactions in your state were investor. The national average is 30%. It's the highest it's ever been, ever on record. So investors, investment properties in the United States, there's over 19 million investment properties that account for over 49 units or doors, let's call it. right? Those savvy investors, right? If their properties are cash flowing, right, they're not going to do a refi cash out of a low note rate. What we're seeing is investors are taking equity out through a closed end or a HELOC. They're taking that equity out and they're using that to renovate their home, their past portfolios, and they're leveraging that equity to buy more investment properties. In the big beautiful bill, there was a tax. There's a piece in that that allows folks that are listed at or listed as real estate professionals to accelerate or depreciate the investment properties when they purchase them in year one. They could accelerate it. So if you were to buy $100 or $1 million property, investment property, potentially you could accelerate the depreciation in year one. You would have to do a cost segregation study. 30% on 100 million or $1 million, that's a $300,000 tax write-off that would offset potentially your W-2 income. So what you're seeing is wealthy individuals take advantage of the tax code and this tax code that allows for accelerated depreciation. So who's gonna know what clients are taking advantage of the tax code? The CPAs, right? So knowing that piece, working with investors in your local communities, joining the RIA clubs, the real estate investor clubs, going through your book of business, looking at all the past transactions you did for investors and calling on them and saying, hey, I have equity products that allow you to keep your first rate mortgage so you don't have to cash out of a low note rate, right? The CPAs and accountants are going to tell their clients, don't ever pay that mortgage off because it's cheap money, right? If we all could, we would go back 3 years ago, 4 years ago during COVID, and we would borrow as much money as we could at that low note rate, right? And because it's cheap money. Looking back, I wish I would have borrowed a ton of money at 2.5% because it's almost free money, right? So another way to filter a database for investors is go to your, the local title companies and work with them. Hey, I can help you do more deals. This is how I can help you grow your business. If you introduce me to investors, I can help them cash out of their previous with equity deals. Then they could use that cash to go buy more investment properties, right? So on the DSCR side, what makes us unique from an investor solution standpoint, we have a full suite of investor solutions. You have a non-QM, a DSCR. We have a 5 to 9 DSCR. We have a closed-end second DSCR, and then we recently just rolled out a DSCR HELOC. Not available in all states, but if you're doing transactions in the states, we offer that, and that would be applicable, or you could use that as well. So full suite of investor solutions, and last but not least, we also have access to fix and flip, ground up construction, and bridge up to $15 million. So if you're working with investors, which is 30% of the market, right, having access to a full suite of solutions, those borrowers don't have to go, or those investors could just come to your shop and do business on all their, on all their deals, because you have a full suite of solutions to serve them. They don't have to go to 2 or 3 different shops to get a deal done. You can help them through the land acquisition, through the building of the ground up construction, doing the end loan on the DSCR, potentially taking a closed end second mortgage cash out, do a purchase, right? So now you got 2 deals from one kind of transaction because you're leveraging equity products and you have a full suite of solutions. Moving on. So where to look in your database, right? For the equity, I would look in your database. Everyone should have a list of all their loans they've ever done in the last, let's call it, 5 years. Look at the rates that they have. Look at what they purchased that property from, LTVs when they purchased it from. You should have had appreciation in your region, right, over the last 5 years. Analyze that data, give you good ideas on where to market those, or who to market to. Obviously, you want to be in lower LTVs, lower than 80% LTV. What we're seeing from an LTV standpoint is about a 66 LTV. That's our average, and our average loan balance across the United States is it's about 230,000, 240,000, which is interesting. It's gone a little bit on the high end, but we do see equity products, second lien products on a common basis from $750 to $1 million. Those higher loan balances are common, and we do see them. And then look at, probably the sweet spot is any purchases from 2019 to 2022, 23. That they're going to have a ton of built-in equity. And then past cash out clients, if they've cashed out before, it'd probably be a good, call to say, hey, in the past you cashed out, you got this rate. Are you looking to cash out again? Are you looking to fund your business? Are you looking to invest in real estate? Are you looking to consolidate that? Are you looking to renovate your home? That's the big one, is the renovation, because the average age of a home is 40 to 50 years old, right? You could just take the cash out, and the borrower could go pick their contractor. The borrower could, find their folks. Unlike a 203K or a home style renovation loan where you have to get the contractor and all that, if the borrower just wants to take equity out, they could go find their own people. Speaking of contractors, that's another great place to get leads from. The contractors, the roofers, the people that are doing the rehabs, when borrowers go to them looking to do a rehab, and they don't have the cash to pay for, or they don't want to take a credit card, the debt out on a credit card because of the higher rates, right? Those contractors are going to refer people to you because you have a solution for them, for the work that they're going to be doing. So a couple ideas there. Moving on to the next slide. I think we're the playbook. All right. So playbook, equity review. Every past client gets an equity review touch. Once again, the top originators in the country, they stay engaged with their clients, right? If you pick up the phone and you check in, it's a great conversation to have. Congratulations on their equity. Congratulations on your low note rate. How's life? How are things? Do you have any financial needs? I think, sending an email, there's a lot of data sources out there that can give you data on values of people's homes, right? You could, there's mortgage industry, vendors, outside of those, you could always use a Zillow to see what the value is before you call. An email is a great way to stay in touch with them. We are actually are in the process of creating a playbook for our clients, like a drip campaign, probably, let's call it 15 emails, where you could send an email every other week. Maybe 1 week it's about renovations, 1 week it's about debt consolidation, and just continue to drip campaign those clients. If you're not doing it, I promise you the servicer is. The servicer will call, will email, will text, will send it in the mail, and their when they get their payment book, right? They're aggressively targeting the book of business that they've bought loans from originators over the last, let's call it 10 to 15 years. You're seeing a lot of consolidation in the servicers. You saw it recently with, there was, a head-to-head battle between UWM and Cross Country for, a servicing book recently. And They want that servicing because they want to solicit that client. They want to target that client. So if you're not doing it, the servicer is. And here's why it's important to embrace equity products. If the servicer gets the second loan after your loan, the retention rate drastically worsens for the originator who did the first loan. If the servicer gets the equity loan, then their retention rate when it comes to do a refi cash out increases to over 90%. So think about that. If you have a book of business and you have 1,000 borrowers that you've done a loan for over the last, let's call it 10 years, right? And you don't stay in front of them and the servicers solicit those clients, right? If they get the second loan, you're only going to have your best shot is going to only be 10% to recapture those 1,000 clients, which would be 100. If you did 100 units, you might get 10. But if you stay engaged, your retention, and you offer these type of products, your retention rates increase dramatically because you're staying in front of them. If you don't stay in front of them, someone else will, right? Obviously, voicemail, postcards. I'm sure everyone here has their different, marketing, let's call it different marketing approaches and what works for them. I would just incorporate equity into your strategy. Think about it as retention and recapture as a strategic thought and plan, and make sure that you incorporate it into your origination, playbook. Once again, the refi cash out game today in today's rate environment has been sidelined. The cash out game is equity, and and there's expected to be about 150 billion in equity production in 2026, as much, if not more, than non-QM. So, moving on. I think that's So the 30-day recapture sprint. So, look, here's an interesting quote. 84% of borrowers say they'd use the same loan officer again, but only 20% actually do, right? So these are a couple highlights. I think this deck's going to go out, but week one, build your list, target self-employed, target investors, target all your past clients with equity that have closed over 2 years, or maybe they've closed recently, right? If you think about it, we have not only second lien, but also first lien products for HELOCs. But if you think about it, I think close to 30% of purchase transactions are cash. A lot of people, they buy the house cash. Guess what? It's not the way they want it. It's not built to their standards or their style. They bought it cash because they got a good deal, or they bought it cash because they wanted to be competitive. Well, it's an opportunity for you to offer a solution to cash buyers. Also, 40% of Americans own their home free and clear. Guess what? They have financial needs. So there's products, for those borrowers as well. Week two, warm database, send personalized emails or equity review email, send a postcard, maybe do some educational videos on social posts. I can't tell you how many originators that I run into across the country that are on social media like TikTok. And I met one like a month ago. He's doing like 20 non-QM loans a month, and they're all coming from TikTok. And I see those cases again and again and again all over the United States. Like I get them on my phone for Rocket and Mr. Cooper and some of these big box servicers that they're talking about second liens. That's what they're pushing. They're not even pushing, standard refi cash out products. I'm a big believer in picking up the phone. They're right, or in person if you can meet with your past clients. We're all human. We all like a feel-good experience, right? And I think more business gets done in person than via email or email. I do see a lot of folks get success with text to their past clients. So I would encourage a loan officers, think outside the box, try something new. Don't be afraid to try something new and think outside the box, right? And then week 4, close and refer. So yeah, week 4 is the close, and that's about it. I think Sonia, we're going to kick it to you if I'm not mistaken. The products,
Yeah.
the overview, the product guru, Sonia.
I'm a solution guru.
That's right.
We're in sales, right? No one tells us no. Our borrowers call us, they need us, and our job is to provide a solution. I'm a big phone person too, so if we ever get a chance to connect out there, you'll be hearing a lot from me. Because a lot of the things, all these marketing campaigns are done to stay in front of everyone, but when you pick up the phone when somebody picks up your call, you're already in the door. They want to talk to you. So I would say I actually have to give a little anecdote. I had a couple of my brokers call their clients, see how things were going. Everybody wants a rate and term. If you say, I can save you money, they're going to let you keep speaking, right? 7 people ended up needing a closed-end second. They had no idea it was an option. And so it's such a value add for everybody. And again, it's kind of cheesy, but I really get satisfaction out of knowing that we can offer a solution like that. And the borrowers are genuinely grateful, because the thing is, these borrowers don't know what to ask for. If we're not in this space, you just don't know it exists. There are loan officers out there that don't know this is an option for their clients. So all that to say, when you think of an equity product, so whenever you see equity in our suite of products, think of just that. It's a closed-end second product. It's a second lien product. And we're going to make it easy for you to identify which product would best fit your client's needs. So we've got our Equity Advantage. That is our flagship closed-end second product. Just Equity Advantage is all you have to know, okay? That's going to be, think of flexibility. So if somebody says, my taxes don't show as much, perfect. Bank statements, maybe they're a P&L client. We now have asset utilization as an option for a closed-end second. Again, so many people do not know. They just assume they are capped out based on whatever their taxable income is. So I love being able to then enlighten those same people, like, hey, you could still get the money that you need, and you can actually get it as cheap, or just as cheaper in some cases, than the options you were looking for. There's people out there applying for credit cards to save more money, or to do a project, or financing with these, like these home improvement small lines of credit, and we offer and then they just have more debt. Right? There's no solution to pay that off. These are 30-year fixed products. There's also something to mention. There's HELOCs that have become, they're not drawing on anymore. They're just out there that they need to do something with. So again, think of the Equity Advantage product for when you need to go up to $1 million. You can go up higher in lien amount. Again, all the alternative income documentation options. And then you see the high level bullet points there for eligibility. We can go all the way up to 50 on DTI. I think that surprises a lot of people. So again, it's not a no until it's a no, right? So if you're unsure, let's poke around and find out. Rural property, again, that's a difficult one, but in a lot of instances, we can do that as well. Non-warrantable condos in Hawaii. How many times
That's
do you
a
hear
big one. The non-warrantable in Hawaii, second lien. I'm not aware of anybody can do that.
Fannie, let's see, agency is now switching over. They're removing the light option for reviews. So there's so much opportunity there. If your only strategy is that you're going to start marketing to these properties, people in these condos that are warrantable by every other definition except they're not eligible for a light review, non-QM, closed-end second. We don't have to touch our first. That is everyone's baby. Any interest rate under 5% is someone's baby, right? So we can save them as much money. Again, we're able to check most of the boxes on these Equity Advantage products. I would say the next level would be our Equity Advantage Elite. So if you're thinking a full doc client, very straightforward, more simpler underwriting profile, that's what you're going to go to for that product. Not as much leverage, only up to 500,000. So think of that product. And then of course we have our Equity Advantage DSCR. I would say the majority of the people who I speak to who don't do a lot of DSCR, when they realize there's a second lien option, there are so many light bulbs. I've spoken directly to investors. I've spoken to loan officers. It's such a great tool because the property is cash flowing. You can get more money at a cheaper price and use just the subject to qualify. You don't have to claim more on your income. You don't have to deal with agency, non-owner, all that paperwork and more tax implications. So again, checks a lot of boxes. Long-term rents only. Keep in mind you need at least a 1 ratio on that. But again, great solution. If you have any investor lead sources, one of the pain points that I keep seeing are that sometimes the draw period for their RTL loans may not be lining up with what they need. And some of these people go for extensions. Like that's an opportunity as well to just do a closed-end second using our DSCR product under Equity Advantage. So 3 options: just the Equity Advantage, just regular, flagship. And again, if you have any questions, just reach out and let's figure out what the solution is for these borrowers. Right, Tom. So yeah, I mean, that pretty much covers the closed-end second product. I think sales and homeowners alike, depending on where we are in our journey, we think of a second lien, and there's a lot of questions. So I think first and foremost, these are fixed rate options. Everybody has a credit card, but there's no plan to get out of that payment, right? The closed-end second product is fully amortized fixed. You even have the interest-only option too if these people are payment sensitive. But again, the bottom line is it's not a no until it's a no. Let's figure out how to maximize their equity position so that they can improve their position. And I will say, you were talking about servicing, Tom. I started in the business at a retention center answering the calls. And being the originating loan officer on your end now, these people would much rather be doing the loan with you.
Yep.
So call them, text them. If some people there's CR, if you need to rely on technology, if you don't, thank God for Apple Calendar. I used to put all of my clients' birthdays in my regular personal calendar, and I would just text them when their birthday came up. So yeah, hopefully, again,
I would say too, on the resources and tools outside of just like the product, because I would say we have an arsenal of products, whether it's non-QM, right? Your standard bank statement, DSCR. We have a full suite of equity, closed end to $1 million, jumbo closed end to $1 million, and we have a HELOC, depending what state, up to $1 million. And then we also have RTL, fix and flip and bridge. But outside of that product offering, we have really robust, I would say, resources. We do offer ongoing training and webinar. We could do series. We probably have 15 or so different webinars where we could teach you about the products, how to source these products. We could go deep dives into products. There's a lot of different things. We do a lot of we have flyers for these products. So if you're looking for flyers, we could provide you with our marketing white label flyers, so you can put your name, your logos, your contact information. We also do a lot of white label presentations with our customers and their partners. So for example, let's say you wanted to present to investors on the investor suite, whether it's DSCR 5 to 9 and equity products, right? We could present on your behalf with one of our trainers. They never know it's Deephaven. We could put your logo and your contact information on the presentation. You would kick off the call, then we would present on your behalf. So we do a lot of white label presentations. We have a scenario desk that does about 4,000 scenarios a month. And so outside of that, I would say you have Sonia, or your Deephaven AE. Sonia is highly skilled, seasoned, is responsive, knows our products, could help you, through the, structuring of the deal. I think that's important as well. right? What else am I missing? I think Sonia's you're probably your number one resource at Deephaven.
Yeah, just think of that equity advantage product like your Swiss Army knife. There's a little bit of everything. So let's figure out what it is. And I would just love to figure that out with you.
Good deal.
Awesome. Thank you so much, Tom. Thank you so much, Sonia. I loved that presentation. And I think that what you brought up, Tom, is so amazing right now with the volatility of the market. I just got back from Mastermind a couple of weeks ago, and believe it or not, loan officers are still talking about the high interest rates. And I'm thinking to myself, they just came down 3% from where they were the last couple of years. What are you talking about? They're so low. But
yeah, the key is a mortgage professional is showing value, taking a financial advisory approach, and the LO that's sitting on the sidelines thinking that rates are going to come down, like they're in the wrong mindset. Like the market is shifting, and you need to shift, right? And you need to adopt product, and you need to provide value to your clients and your referral sources, and the ones who do. Right, they're the ones who are known for their expertise, knowledge, and focus. And the pros in the mortgage space, just like any other profession, whether you're a doctor, or a surgeon, or a financial planner, or a CPA, people will go to you because you're good, you're an expert at your trade, and that's how mortgage professionals, that's why they gravitate to people. I know Kelly does a ton of Ginnie Mae and especially VA. She's like the VA queen, right? And people go to her because she's known for her expertise, knowledge, and focus, right? So I would say if you're an originator and you're not skilled in non-agency, once again, it's going to be non-QM is going to be $150 billion to $180 billion market this year. The equity is going to be about $150 billion. RTL is going to be $50 billion. Then you throw in some esoteric products, you're looking at a $400 billion market, and third out of a $2 trillion, and it's going to continue to grow. And so 1 out of every 4 or 5 deals are non-agency. So if you don't embrace that, you're leaving 25% of the market on the table. If you don't embrace investor solutions that are 30% of the market, you're leaving potentially a third of the market on the table. If you don't embrace VA being in Hawaii, like you might as well get another job, right? So we're a very entrepreneurial spirit. Look, there's a lot of veterans that are self-employed, right? Veterans, they might need a bank statement deal because maybe they make so much money, they have a great account, they write everything off, right? They need equity to grow their business. There's a lot of veterans out there. I know a handful of veterans that are self-employed when they get out of the military, right? So there's opportunity in every market. Either you get it or someone takes it from you, right? So that's what the purpose of this, call is, and that's what we try to drive awareness is help LOs do more deals so they can make more commission than they made the year before.
Absolutely. And I love flipping the conversation from interest rates to equity. Let's talk about how much equity you have and how to extract it. I'm sorry, Sonia, go ahead.
No, I just was fervently agreeing with everything.
And Kelly was agreeing with me on the VA queen. I know.
Yes. That's the best thing you said all day.
So we do have a couple of questions. So everyone on the call, our chat box, our question box is open. First question actually is coming from me. I've got a question for you. So speaking of investors, obviously with home prices in Oahu being exorbitant still, we've got a lot of folks going into the Big Island, and Lava Zone 2 is a hot topic. Is Deephaven closing loans in Lava Zone 2?
No, unfortunately not. The number one Hawaii question that I get. No Lava Zone 1 and 2, but it's a teeny tiny part of the state, right? So everywhere else.
We can do non-warrantable condos. We're a non-warrantable condo shop.
Perfect. We've got another question from Catalia Rudolph at PRMG. Can you please tell us about the seasoning requirements on the second mortgage product? So how soon after they purchase can they lift out some equity?
Yeah, so it'll depend on your situation, but basically there's no ownership seasoning for primary residence. If there's less than 6 months, I believe we're at 10% LTV reduction. So again, come with me for your specifics, but that's not a deal breaker if there's a seasoning concern.
Okay. What about investors?
For investors, I'm thinking about
I'm
our
seasoning for a cash out.
yeah,
Yeah.
Like
I'm
let's
doing
say win the deal or get the,
So
get the special
we
fix and flip.
yeah, since we have an RTL suite of products, we've aligned our products to actually align with the RTL. So
Mhm.
let's say someone does a fix and flip and they want to use the appraised value to cash out, right?
I'm doing one now.
We could use the cash out. We could use the appraised value so as long as you show the improvements like the next day. Like you don't have to wait 6 months or 12 months because that aligns with the investor that's doing the cash out, that's doing the fix and flip. So we're providing the end solution. So that's great for LOs who work with investors. If you go to an investor or investor community and you say, hey, I could do cash out within less 6 months on an appraised value, you're going to get a lot of phone calls, and we could do that.
Yeah. And so specific to our DSCR product, there is no seasoning requirements. Again, like Tom said, depending on the situation, they can get cash out up to 75, they can go rate and term. But for a closed-end second, you do need to meet the minimum 6 month. But again, in an investor scenario, usually they're not looking for a second, they're looking for that first, and we can do it all day long.
Perfect. What about the DSCR 5 to 9 unit? What are the loan limits and LTV there?
Let's see. I got all my first lien part. We're going straight to the 5 to 9s. All right, we're going to be at I believe it's 3.5 million on the 5 to 9. Hang on one second. Let's see here. And I believe we're going to be max. The max is going to be 70. I just did one the other day.
So 70 LTV. There's no mixed use. It has to be resi.
No, true
We can.
resi.
That's something that's on the roadmap that we're looking at to do the mixed use, but that's more to come there. But it's just pretty much all resi.
Perfect. And then I did not see any renovation, actual like fix and flip or renovation products in your offerings.
Yeah, so we do have. So we're owned by a company called Pretium, which is an asset manager, residential asset manager. We own our own servicer. We own our own due diligence. And by the way, our servicer does not have a retail channel, so we're not soliciting those borrowers, right? But on the renovation, on the fix and flip, I can go to 15. So we could do a bridge loan for 15 million to acquire the land, then do the ground up. We could do, I believe it's 90% loan the cost. And on the reno, the fix and flip, I believe it's 90% of the purchase price. So 10% down. So let's say they bought $1 million property. They could put 100 grand down, but we could we could finance the full rehab into the transaction. And I believe there's been some enhancements recently that allow you to go more at a higher LTV, maybe 95, depending on the experience of the contractor or builder. What we look for is like 3 transactions. We could do less than 3, but 3 is the magic number. And once the builder or contractor is approved, we never have to get them approved again. It's one approval and you're good to go. And the experience doesn't have to be like in the last year. It could be over a lifetime.
Oh, that's awesome. Because I know that is a really, really popular program right now in Hawaii. With the home prices where they're at, the homes that are coming up for sale that are reasonable or affordable generally need a lot of TLC.
Yeah,
and that's
sure.
why they're priced so well. And finding good lenders that can help the buyers to not only acquire the dilapidated property, but also to rehab it is extremely important.
Yeah, I mean the 15 million is like on the guideline, but we could, depending on the type of property and the builder, we could go actually higher. Like we actually do it. We have an institutional group in the organization that we do projects up to $300 million. Not
Oh,
like
wow.
condos, but they're like, you know, single family home like communities. So imagine that if you go to a builder, right? Think about the you know, a builder or a fix and flipper, and you can give them the financing to do these deals, because most of the fix and flip and the ground up is like 3.5, 5 million. I could go to 15 million. But if you have that product, right, what that allows you to do is once you get them the financing for the build, or you give them the financing for the fix and flip, you could say, hey, when you're done with that project, I want the second loan. So now you got 2 paychecks versus one. And unlike a consumer that might buy a house once every 5 years, 7 years, the average investor on an annual basis does 7 transactions a year. So aligning yourself in the investor community, the folks that really focus on investors, they're not at 30%. They're like 70% of their business is investor production, because they've created a niche. So that's why I mentioned those products, to give an edge to the loan officers.
I think that's great. That definitely enhances the offerings and picks up on the peripheral. That is awesome.
Yeah.
We've got another comment here from Wade Nakasone, our Hamby president. Can we count on Deephaven participating again in our golf tournament this year? Tom,
I flew all, hey, the last time I was in Hawaii last year, and I was at the golf you know, pro shop, right? And I was at the golf pro shop, and I said, let me buy myself a nice Hawaiian t-shirt, or, you know, polo. I got home and I looked at the polo. There were Bahamian. I thought there was Bahamian flags. It was a Bahamian polo, and I bought it in Hawaii. So yeah, you know what? We could definitely talk about that, Wade. Would love to be out there. If I can't make it, maybe we could send Sonia to set up a tent. That's something we'll circle back. Sonia, let's connect with Tyler on that. I'm sure Tyler would want to participate. But we fully support Hawaii. Look, I earned my stripes early on in my career at a place called Chase Rural Housing, and I helped really grow that product in the state of Hawaii from like right outside the financial crisis, from 2009 to like 2000, like let's call it 14. I met, that's how I got introduced to Hawaii, and worked with brokers and bankers in the state of Hawaii. Worked on legislation with some of the congressmen and senator, even worked with Senator Inouye's office on a Farm Bill, Rural Housing Preservation Act, and some other stuff, because he headed up appropriations. So and the clients in Hawaii actually helped me with moving things on the legislative front for the USDA program, the 502 Guaranteed Rural Housing Program. So I've always been a big supporter of the state and the people. Some of the most friendliest people in our country, and I love your state and the people there. And if we could support, we'll do it, Wade.
Awesome. Well, we are right at the end of our time here. It's about 10:58. It does not look like we have any other questions. Anything that you'd like to close with, Tom or Sonia?
Yeah, I would close with this, and Sonia, you could close it with something too. But I would say, I think the market is going to continue to be, this kind of $2 trillion market. It's going to be challenging. The LOs who have the widest product set, who know their products, who can provide value, who stay engaged with their clients, they're the ones that are going to win. And, to give you an idea, here's another stat. The top 5% of realtors in the United States control 90% of the listings. So the top 5% of realtors control 90% of the listings. If you're an originator out there, become a product knowledge expert and tap into the top 5% who are moving the deals. Don't spend the time with the realtors that don't have the deals. Focus on people who have transactions, right? And provide value. And if you have these products, or the products that I'm talking about, like if you're not introducing, if their LOs that they work with all the time don't have these products, this is your way in to penetrate those relationships And so there's plenty of opportunity in the market. Either you get it or someone takes it from you. And I don't like when people take stuff from me. So I like to go out there and take share and drive production. So Sonia, what do you have for us?
Yeah, I mean, I think the hardest part in being in this business is the lull, right? We always use a 2-year average in this business. I say if you're a loan officer, it's a 10-year cyclical average for income. But staying motivated, and when all you hear is the rates are higher and your borrowers are telling this to you and other people are telling you, they're not just landing in your lap. There's no purchase business. The rate and term market there's no refi business. There is refi business, there's equity business. And I think some people even think, well, it's, $150,000 is worth my time. If it's non-owner, you can take a yield spread. It's like correspondent pricing, front end, back end. You can maximize your income and do less in volume and make the same amount of money. So I think just stay motivated, knowing that, like Tom said, there's so much business to be had. It's our job to then let everybody know that it's an option. I don't think people are taking that option because they don't have loan officers who know how to bring that to the table. So let's solve some problems. It's a solution product, and it's just as valuable, if not more, in my opinion, as just a rate and term transaction that those borrowers sure love.
Amazing. Thank you, Tom. Thank you, Sonia, for your help today and for your time today. Thank you, Kelly, for everything.
Thanks
And
so much,
thank you
guys.
all with Hamby. And we'll see you next time. Thanks for attending. The webinar will go out in the next 24 hours. You're
We
welcome.
appreciate you. Thank you.
Guys.
Thank you.